the primary way we make money in fixed income is, well, the coupon.
Yeah.
Right? So the first and foremost question that's on our mind is, are we buying it at the right yield? In the long run, most of the returns that you expect to make from fixed income will be from the interest or the yield itself. In short periods of time, let's say over a course of 1 or 2 years, the price changes can be very significant relative to coupon. So therefore, both need to be kept in mind when you're making an investment decision. It's very interesting that you have had a couple of bank failures this year without a credit crisis. There's no credit loss. It's not that the US Treasury has stopped paying that debt.
Yes.
Right? It's not that the mortgages which were invested by First Republic were not being serviced. But the reality is that the price of those instruments fell. And when Silicon Valley went to sell those bonds, they effectively wiped themselves out.
Hi, and welcome to another episode of Open Dialogue. Last week we spoke about fixed income markets with Siva, and this week we continue the same discussion and dive a little bit into the economics of these instruments itself and try to understand how they operate. Joining me for the conversation is R. Sivakumar. Siva, he's the head of fixed income at Axis Mutual Fund. Siva has more than 25 years of experience in the asset management industry. He's been part of 2 startup teams in the mutual fund space, starting with ABN and also then with Axis Mutual Fund. Siva, welcome again to the show. So, Siva, will cover a little bit of the instrument itself, right, and kind of what determines the economics, etc. So, just kind of to recap from the last episode, fixed income instruments, let's take a government bond. So, it has basically the investor puts in, let's say, 100 rupees. He or she is promised a certain coupon, let's say 7%. So, every year they will get some interest. And at the end of, let's say 10 years, if the duration is 10, the 100 rupees will come back. So, this is kind of the structure of the... So, what determines whether it is an interesting instrument or whether it is making money or not?
Yeah. So, the primary way we make money in fixed income is, well, the coupon.
Yeah.
Right? So, the first and foremost question that's on our mind is, are we buying it at the right yield?
Right.
The yield is, as you mentioned, like a coupon can be 7%. And if you're paying 100 rupees, the yield is the same, 7%. Right. Yield is slightly different from the coupon in the sense that different securities can have different coupons, and the prices will adjust so that the yields get normalized. So it's important that when we invest for example, if you look at a mutual fund fact sheet, we disclose what's called the YTM of the portfolio, yield to maturity of the portfolio, and that kind of equalizes it so that a higher coupon, a lower coupon, etc., are all equalized. So in that sense, you have a way to look at the entire portfolio or any instrument. So the yield is the first and most important way we make money investing in fixed income. The second is price. Now, we all know equity markets prices go up and down, but bond prices go up and down as well. And this is not something which is intuitive to a lot of people. So as fund managers, we also try to find opportunities in fixed income markets where we expect to make price returns.
Right.
Mispriced securities, for example, undervalued in some sense, or where we expect, because of economic cycles, we expect a price gain. So these are the 2 ways you make money, either through the interest rate or through the price appreciation. In the long run, most of the returns that you expect to make from fixed income will be from the interest or the yield itself, right, the coupon. And the price movements tend to be a relatively smaller share overall. But in short periods of time, let's say over a course of 1 or 2 years, the price changes can be very significant relative to coupon. So therefore, both need to be kept in mind when you're making an investment decision. So that's what fund managers like me, we do, is we try to evaluate which securities to buy based on whether the price and the yield.
So you mentioned one point that I want to deep dive a little bit into, which is a bond is an instrument which gives fixed returns. So why would its price vary?
Yeah, this is something which is, again, it's first principles kind of thing. Let me try to step back and try to explain it in as simple a way as possible. And I'll just use a as 1 year instrument. Okay, so let's say for example you have invested 100 rupees and in an instrument which let's say makes 7%, right? So that means you invest 100 today, and at the end of the 1 year you're going to get 107 back. Yes. 7 rupees of coupon plus 100 principal back, right? No problem. You invested, you're happy. For whatever reason, let's say the next day the interest rates in the economy go up by 100 basis points, and now the new interest rate is 8% in the economy.
Right.
If you had 100 rupees today, you could deploy it in a bond which will pay you 108 after 1 year.
Correct.
But you are already holding a bond which is only going to pay you 107 at the end of 1 year. You say that I want my money back and I want to sell that bond. Now, if I'm a buyer of that bond, I will say, look, I'm not going to pay you 100 rupees for that bond, because my 100, if I deploy today, I can get 108.
Correct.
So I will buy the bond from you at perhaps 99, because from 99 to 107 is approximately the same as 100 to 108. So what happens is when interest rates went up by 1%, the price of the bond went down by 1%.
Right.
This inverse relationship between yields or interest rates and bond prices is crucial. That when rates go up, bond prices go down. Instead of 1 year, if you had a 2-year bond, again using simple interest, 7 plus 7, 14, you got 114 at the end of 2 years. If that interest rates were to go up by 1%, then the alternate investment mechanism 100 goes to 116.
Yeah.
And therefore I would only be willing to pay 98 to buy that 114 bond, right? So, I mean, I'm not using any discounting. I'm not using any.
Absolutely.
So just to illustrate how this happens. So which means the longer the tenure of the bond, the more the price moves for the same change in the interest rate.
Right.
Right. The way to look at it is think of a seesaw. Right. If you sit close to the, it only moves a little bit. If you sit here,
it moves a lot.
It moves a lot. So the longer the tenure is, the more the price moves for the same change in yield, and like a seesaw, the change in the price and the yield move in opposite directions. So if you just keep that in mind, that the longer the tenure is, the more price volatility there is, because the interest rates tend to change for the economy as a whole. So it's not that interest rates for one bond change; they do change, but the yields tend to get correlated, which means they are roughly moving in the same amount. So what really determines the movement in the price is what's the tenor, or what we call duration. And the longer the duration, the more the volatility of that instrument is. So obviously, if we expect interest rates to go down, right, then we want a long duration instrument.
Right.
Using the same analogy, as interest rates go down, prices go up.
Right.
I want to be as far away on that seesaw as possible to get the maximum return possible. If I'm expecting interest rates to go up, then I want to be as short a duration as possible, because then I don't want to lose money as interest rates go up. So this is what we do when we do managing money, that when we are looking at the cycle of interest rates, if we are expecting interest rates to go up or yields to go up, we are actually selling our longer tenor bonds and buying shorter tenor bonds, and vice versa. And doing so enables us to make what we call alpha, which is basically excess return over and above the coupon, to extract that from the market. Yeah.
Understood. Now, as an investor, if I had held on to that, just going back to that 100 rupee, if I had held on to that 100 rupee security for the year,
yes,
I would have not had any price risk.
Absolutely. And I thank you for bringing that up, because it's crucial. Because again, in fixed income, a lot of this price volatility is notional for investors.
Exactly.
Right? Because you buy a bond, even if it's a 5-year bond, you hold it for 5 years. At the end of 5 years, there's no volatility. Because at the end of 5 years, the duration is 0. No matter how much the interest rates have moved, there's no price risk. So you've got your coupons and you get 100 rupees back, there's no price risk. So when you hold to maturity, your volatility reduces. So another way of looking at it is that even if you're buying a mutual fund, for example, right? If a mutual fund has, as I said, a fact sheet says, YTM is so much and the duration is so much. So let's say the duration is 2 years. If you hold for those 2 years, broadly your price risk gets mitigated to a large extent.
Right.
Right?
So
because
you get the coupon, whatever
you get the yield, you get the any alpha generated plus minus whatever the case may be. But by and large, the volatility gets eliminated as long as your holding period is aligned with the fund's holding period. If in the case of a direct bond, if you hold to maturity, your price risk is eliminated. Mutual funds, you don't eliminate, because the fund always has certain bonds in the portfolio.
Correct.
Right? So there is no such thing as completely eliminating the price risk, but it reduces substantially if you hold for the duration of the fund.
Right. And just now come back to the specific words you have, just duration.
Yes.
Can you just explain what duration means?
So duration is just a measure of this. So like I said, a 1-year bond typically has a 1-year duration, right? That's fairly straightforward. But a 2-year bond, because of the compounding effects, right? doesn't exactly have 2-year duration, because there is a you get
Coupon
let's say
in
a
the
coupon
mid,
in the middle, right? So the coupon in the middle affects the duration in a different way than the final maturity at the end. So duration is kind of, one way of looking at it is like the weighted average maturity, taking into account the coupons, in between coupons, and the final maturity.
So the weighted average time at which your money comes back, is that?
In some sense, yes. But it's mathematically a little bit more trickier than that, because we in our calculations have just used simple interest and have not really adjusted for time value of money, etc. But if you actually use compound interest, which is what we should be doing, the numbers are slightly different. So the simple measure is, the longer the maturity, the longer the duration. That's fairly straightforward. For example, a 1-year bond will have close to 1-year duration, right? But 10-year bond will have maybe 6 or 7 years of duration.
Right.
So it's not that 1 to 10, you 10 years, you 10 times the maturity, it's not 10 times the duration.
Right.
10 times the maturity is maybe 6 to 7 times the duration. You go from 10 years to 30 years, the duration probably goes from 6 or 7 years to maybe 11, 12 years or something. So the duration doesn't go up anywhere near as much as the tenor or the maturity of the bond. It kind of tapers off as maturity increases. So typical bonds that we invest in have durations from 0, which is like an overnight instrument, to maybe 10 to 15 years of duration. But the tenors themselves could be very, very long. Government of India issues 30, 40, 50-year securities. So we can be buying very, very long tenor instruments.
Right. And is it also right to say that the duration of the bond is indicative of the price risk, price sensitivity?
Yes, it is. So the formula is, for relatively small changes in yield, change in the price is duration times change in the yield, in the negative direction. So increase in yield, decrease in price. So the opposite direction. So the formula is, change in price is negative change in yield times duration. So which means, for same change in yield, a 2-year duration bond will have twice the price volatility as a 1-year.
So the 10-year bond is 6x more sensitive to the interest rate change compared to a 1-year.
That's right.
And so if you were a smart investor and you could accurately predict a 100 basis point reduction in the yield in the market, if you put money into the 10-year bond, you will make 6x the money that you will make from a 1-year bond.
So yes, absolutely, and vice versa, right?
And vice versa.
Over the last 2 years, it's been the other way. So it's been where you have had a very large rise in interest rates in the economy, where yield on government securities, which were well below 6%, are now trading well above 7%, and therefore you've had a very large fall in bond prices corresponding to that. So obviously, in the last couple of years, the right strategy has been to invest in much shorter tenor instruments and ride out this volatility. And of course, the cycle will change, and therefore you will want to buy longer duration instruments when you expect rates to come down.
Yeah, and this brings me to something that we did not plan to talk about, which is 2 incidents actually. One is Silicon Valley Bank, and second is the incident that happened in the UK, where the pension fund had to be kind of, and both are linked in many ways to what happened to interest rates and what happened to their bonds. So it will be great to get your perspective on the event and what we learned from this.
So typically, banks have a large amount of holding in government securities, which are held to maturity. Now, mutual funds, irrespective of whether we are holding a bond to maturity or not, we value the securities on a daily basis. But for banks, certain part of the portfolio, which is called HTM, or held to maturity, they are held at cost. So whatever historic cost it was held, it is still held on the balance sheet at the same amount. The trading portfolio gets mark to market, but the long-term portfolio is held without market. So what happened in the case of 1 or 2 of these banks which went under recently in the US, is that you've had this very large interest rate cycle. The US Fed has raised rates from 0% to over 5%.
Yes.
Yields on government securities in the US have gone from less than 2% to above 4% right now. This has caused a very large fall in the price of bonds. Now, held to maturity, you will still get your original stated yield, but the quote unquote, the value of that portfolio is deeply negative. It's very interesting that you have had a couple of bank failures this year without a credit crisis. There's no credit loss. It's not that the US Treasury has stopped paying that debt.
Yes.
Right? It's not that the mortgages which were invested by First Republic were not being serviced. But reality is that the price of those instruments fell. And when Silicon Valley went to sell those bonds, they effectively wiped themselves out. So this is a case where the mark-to-market valuation is what happened. Similarly, in the case what happened in the UK. In the UK pension industry, as you rightly said, so there is this concept called liability-driven investing. Now, you're getting a little bit into the weeds of the matter now, but basically what it means is that when you look at the liabilities, which is for pension long-term, really long-term liabilities, which is what they have to pay the pensioners, versus the income from the bonds, for example, right? And not necessarily that the bonds have the same duration as the duration of the liabilities. The liability tends to be very long duration in nature. So what they have done is they've used derivatives to extend the duration of their portfolio. So suddenly when you have a large rise in yields, as what happened in August last year, when the UK government came out with a new sort of a growth plan which projected a much higher deficit, and therefore the yields on UK gilts rose sharply and the prices of UK gilts fell sharply. Those derivatives went underwater. Now, obviously,
and significantly because they extended duration.
Yes.
Which means that the sensitivity
much higher.
Was much higher.
But the sensitivity is not so much important on the bonds themselves because they are kind of, remember that liabilities are matched. So over the long term, it is expected that it should be neutral.
Yeah.
But when you have a large fall in the value of derivatives, you need to fund that margin. There's a margin call.
Right.
How do you fund the margin call? You have to sell your G6, your treasuries.
Right.
Your gilts.
Right.
That causes a further fall in the prices.
Right.
So this became a kind of a cascading effect where you sold gilts.
It fell further.
Further fell. Yeah. That created a further margin call, and this was cascading to be a crisis situation before the Bank of England intervened. So this is very a unique situation where, and you don't really see this happening in many parts of the world. You saw this with LTCM back in the late 90s, where again a dislocation in US Treasury market and of course the Russian default really caused that hedge fund to fail. So occasional such failures happen where you take very large duration positions and then you can get wiped out. So it's something to keep in mind that even though these fixed income instruments and especially things like treasuries and gilts and Indian G-Secs, etc., look like safe instruments, you still need to take into account the price risk that you run, especially if you're using derivatives.
Right. And so hence, so again, kind of just to simplify this a little bit for my own understanding, the bond itself is fine because had you held it for those 10, 15, 20 years, the money would have come back. But something happened which required you to liquidate it now.
Yes.
And right now you were deep in the red because of what's happened to the interest rate cycle. And that's what kind of compounded this, right? And so you sold, and when you sold more, the bond price fell even more, and so on and so forth. And hence perhaps the thing to think about is that in the risk management, while the bond is safe and while you are holding it for 30 years, you still have to think of a situation where you may have to liquidate, and hence you have to have the right risk management and,
Yeah, so. So it is sometimes, what happens in this instance with both the Silicon Valley as well as many UK pensions, they took the government and the central bank's word for truth, which is to say that many of the central banks said that, we're going to be at 0% interest rate forever, for the next 2 years, 3 years, 5 years. We're not going to raise rates and so on and so forth. So all these guys said, what am I going to do? If I hold cash, if I hold short-term bonds, I'm going to get zero. Many countries, remember that negative interest rates prevailed at that point of time. So even holding short-term securities was actually causing you to lose money. Yeah. Imagine a world. What does negative interest rate mean? Imagine a world where the lender pays interest to the borrower. It is absurd.
Yep.
The lender pays interest to the borrower, not the borrower pays interest to the lender. It's absolutely absurd, right? That's where we were. So holding many of those bonds are not profitable. So what do? You have to find something which is profitable, which is giving you at least some positive yield. And the only way to do that was to extend the tenor.
Right.
And then when yields went up, those bonds went underwater very, very quickly. So sometimes what happens is that these kind of extraordinary monetary policy, when it happens, we need to be very careful.
Right.
That we don't just say that, okay, my God, yields have dropped so sharply. Where can I get compensation for the yield? Okay, let's find something which is more risky.
Right.
Maybe take more credit risk, maybe take more interest rate risk, and then find yourself in the soup a year down the road or 2 years down the road. So it's something that we should resist temptation to kind of chase yields especially when you have extraordinary monetary policy, especially like we saw in COVID.
Right. Shifting tracks a little bit, Shiva, typically bonds and equities are negatively correlated, which means when equities do well, bonds typically don't tend to do that well. And when bonds do well, equities don't tend to do that well. Why does this happen? And
yeah. So as we discussed, right, the price of bonds go up and down based on the interest rates in the economy. Right. Now we need to get into what causes the interest rates to change.
Right.
So interest rates are typically correlated with the economic cycle.
Right.
So when economy is booming, everybody wants to borrow. Right. If everybody wants to borrow, there's a chase for money.
Right.
And therefore people are willing to pay a higher rate of interest to borrow.
Right.
So therefore interest rates go up. Right. And the Reserve Bank of India also typically raises interest rates to cool the economy down. Right.
Yeah.
And when the economy turns down, money is still there, but fewer people are borrowing. So the pool of money is chasing the few borrowers that there are, and interest rates go down. And the Reserve Bank also wants to cut interest rates to stimulate borrowing. So you have an economic cycle where rising economy or stronger economy, rising interest rates, therefore possibly falling bond prices. But rising economy is typically good for equities.
Right.
So when you look at the economic cycle and you look at it, rising, better performing economy, rising equities, not so good for bonds. Economy turns down, not so good for equities, good for bonds. So this is why you get this kind of inverse correlation between the interest rate cycle and the equity cycle.
Yeah.
It's not set in stone that these are, especially timing. Typically, the cycles can be slightly off, but broadly, you
the other way to think about this is when the economy is doing well, people have more money, and so they are consuming a lot, which means inflation is also kind of rising.
So one symptom of strong economy typically is that people are willing to pay higher prices also, right?
Exactly.
Because if you're feeling good about yourself, if you're feeling that you've got more income, you also typically spend more.
And so as you spend more, inflation goes up. And as inflation goes up, you need to raise interest rates to incentivize the people to save.
That's true. So that's part of so when you look at the other side of the story from the borrower side, when you look at it from the saver side,
right,
it's the same thing, right? If your economy is doing well and you are spending more, how can I incentivize you to save more? The only way is to offer a higher rate of interest.
Right.
And by what the RBI does when, for example, in the recent past, they have consistently been raising interest rates, in a sense, is to signal to people that please save more. You're getting better compensation for your savings, and cut back your spends.
So inflation will also come
down. Cool inflation down.
Yeah. So now, Shiva, in the last cycle, particularly in the US, this correlation hasn't held. Right. Interest rates. I mean, I'm not talking of the last 1.5 years, but if you think of the, let's say, 6-7 years before that, interest rates have, equities have rallied, bonds have also rallied. So what happened?
So that is an extraordinary case where you saw, especially post GFC and the decade thereafter, where you saw a consistent fall in yields as the Fed, for example, left rates at zero for a long period of time. And in the case of Europe, the ECB took rates to negative, Japan took rates to negative. And when your rates start going down so consistently over a long period of time, bonds continue to do well. They also started doing things like what's called QE, which is quantitative easing, which they were buying up treasuries and releasing cash into the system. So in effect, they were stimulating the economy. They were continuously stimulating the economy, and equities were doing well. But the way they were stimulating the economy was to drag interest rates lower and lower, and therefore bonds were doing well. So you had this unique situation where the economy was actually doing okay.
But rates were falling.
But rates were still falling.
Yeah.
Because I think this is generational error by central banks to cut rates when the economies were doing okay.
Right.
Right. These same central banks have struggled to come out of those zero interest rates or negative interest rate policy because, well, those are wrong policies to start with, and it's very difficult to wean the economy from free money. I mean, when you have zero interest rates, it's essentially free money. I'll give you money today, and you promise to pay me that same amount of money back after 5 years, 10 years. In the case of negative interest rates, like I said, the lender is paying the borrower.
Yeah,
I have to give you less money back. It's a fantastic. So that look at the incentives that it creates, right? It creates such bad incentives for economic participants, right? If money is free, then, well, you get so-called unicorns, which Many of them have become unicorps today. We saw WeWork spectacularly coming from a $50 billion to bankruptcy. We saw one large Indian edtech company which also had $30+ billion now being marked down by more than 90% by one of the investors. So some of these valuations and some of this happens because you have free money floating around, and therefore chases assets and investments which are not necessarily profitable, right? If you have, for example, negative interest rates, which means keeping your money in a bank FD or in a bond, you're losing money, then anything else looks better. And even if a business plan looks bad, it looks okay because the alternative is losing money in cash or in treasuries. So now I think, yeah, hopefully that's it, and world will not see too much of that. I think Japan is the last country, hopefully comes out of that, and then we'll no longer see negative interest rates. It's something which should be, I mean, I'm hoping a lot of PhD dissertations and central bank papers will kill this menace forever. Because at the end of the day, as savers, negative interest rates is about the worst incentive that I can have.
Right.
Effectively, it is forcing us, negative or very low interest rates, whichever the case may be, is forcing us to take risk, which is not appropriate. Even at the macroeconomic level, the economy is taking risks which you should not.
Right.
We talked about the UK pension funds, or you look at Silicon Valley. Or why did all of those incentives happen? All of those incentives happened because of ultra low interest rates. So yes, sorry, a long way. You wandered a long way away from your original question, which is what happened when you had falling interest rates despite strong economy. I think, yeah, we are paying the price. To some extent, we are paying the price of those decisions today.
Right. Great. So Siva, let's just pick up on this topic of negative interest rates. And can you just, it's kind of a concept that is bizarre to understand, but can you help us understand what does this mean, and like how can a bank charge a negative interest rate to a investor or a depositor, and what happens, like what happened in these economies when stuff like this happen?
Yeah. So for many retail investors, they really did not see negative interest rates.
Sure.
Okay, because if you're a retail depositor and you go to a bank and the bank says, listen, I'm going to charge you for keeping money, you're going to say, okay, give me the money, I'll take it home and keep it in cash. Keep it in cash, right? Because cash is zero. You cannot get, if someone charges you, but yeah, that works if you've got 100,000 euros and you want to keep it, even that's a lot of money. But what if you have 100 million euros, which is typically what an institution will have?
Right.
Then you can't keep the money in currency notes. So then it has to go into a bank or into an instrument and actually loses money. So typically what happens is, it's not that the coupons of those instruments are negative, they would typically be zero, but you will be buying at a price above 100. So you invest at 101, you get back 100. So effectively you lose money on making those investments. So now if you have this kind of negative return, so which means at the time of investing that I'm going to lose money, it kind of really upsets you, right? I mean, it's natural, right? That if you say that, listen, here's a guaranteed loss, please invest. Why? So a lot of people ask that question, and the answer is, let's not put money here.
Yep.
Right?
And this, just to clarify, this instrument is the central bank borrowing rate, essentially.
So this is the central bank setting a rate which is negative. This is a rate the central bank effectively. So, okay, let's maybe step back and explain that also for a moment. So the central bank sets a policy interest rate, which is a rate at which the central bank transacts with banks.
Correct. So if a bank keeps money with the central bank, the central bank gives a certain
rate
interest to the bank,
bank.
And that interest rate is what they set as negative.
Correct, as set as negative.
So central bank has said, please, essentially they are saying, please don't keep money with me.
Don't keep money with me.
Yeah.
But because they also did QE, which means what they did was they were buying treasuries, German bonds or French oats, etc. They were buying all these securities from the market and they were giving cash to the banks. And what do the banks do? They can't do anything, but they have to put it back with the ECB at negative interest rates.
Right.
And so what was happening is that the bonds became more and more expensive, right? So people said, okay, whatever bonds I have, I'll hoard it. So the prices of the bonds started going up to the point where those bond yields also became negative.
Right.
So when you have central bank policy interest rates go negative, eventually even the bond yields started going negative. And once bond yields also start going negative, then naturally people have to ask the question, what am I doing keeping money in an instrument where I'm guaranteed to lose money for the next, let's say, 10 years? So you start finding other ways to deploy your cash. And that is, like I said, you had a lot of malallocation or malinvestments. A lot of money went into businesses which really didn't deserve it. So, the classic, we saw this We saw this, for example, even in the previous cycles also, where if you have negative interest rates, give you a classic example, like, you buy some inventory of some stuff, and just store it. And assuming you can sell it for the same price a month down the road, or 6 months down the road, 12 months down the road, it's still better than holding it in cash.
Yep.
So people started hoarding. People started investing in anything, even if it is not really a good business plan, makes sense when the alternate is losing money, right? This was all going well until COVID, right? And post-COVID,
I think my favorite example is the NFTs.
Oh yes, sure. NFTs, absolutely. Picture of a monkey or an ape or whatever it is, and so many of them. I mean, and that market has completely vanished. The moment interest rates went to positive, the market for a lot of these stuff just vanished, and effectively, it makes sense, right? Why would you? And it's a digital picture of a monkey which anybody can copy. Yeah. So what is your right to that image? And so many other NFTs which were created. The whole crypto infrastructure. Now, I do understand that there are certain technologies there which will prove hugely important over a period of time. But many crypto coins have essentially become worthless the moment interest rates started going above zero. Right? So I think a lot of this money started sloshing around and finding its way into poor investment decisions. And as we have come out of COVID, and as inflation has risen globally and interest rates have started rising, it's like what they say, right? When the tide goes out, you find who's swimming naked. And you found that a lot of these businesses have just started going under because the only rationale for those businesses to survive was free money. And the moment you took away free money, a lot of these businesses have struggled.
Great. So, Siva, coming to the last question for this topic, which is interest rate cycles are critical to the fixed income markets, but also more broadly, right, to what happens to the economy. And there are cycles, as you have discussed. So, where can you just talk about a little bit how this has evolved, where we are now, and what could potentially be like the evolution?
So, I think thanks. This is an important one because we've had some fairly large dislocations over the last few years. Especially during COVID and after that, right? So during COVID, you saw economies grinding to a halt kind of a situation where you had large fall in demand, consequently large fall in prices or inflation in many parts of the world. The response to that was extraordinary monetary policy. You had rates coming down, you had quantitative easing and other kinds of liquidity measures. And then when economies opened up, all that money which was sloshing around suddenly found its way into every kind of activity. Economies picked up and you had a rebound in demand and rebound in inflation. So economies are scrambling to close the gap. I think central banks have largely won that battle on inflation today. So we see, for example, in RBI, right, that RBI quite rightly has been worried about inflation. Inflation over the last 3 years plus now has averaged well above the upper end of the RBI's threshold of 6%. So the RBI officially has an inflation target of 4% within a band of 2 to 6. And we've been above 6 for the last 3 years. And now we are finally below 6. And more importantly, the trajectory now seems to be to get significantly below 6% and probably heading towards 4. We may not reach 4, but at least direction is pretty good right now. The same is the case with many parts of the Western world. Inflation still is above target, but most parts of the world, inflation is heading towards their target. And as we go every month, every quarter forward, and as central banks become confident of hitting those targets, you should start seeing interest rates come down. We have had very large rate increases over the last few years. I think we will see not as large, but quite a bit of rate cuts in the coming year to 2 years. Our own expectation is that mostly the US Fed will be the first to start, as is often the case that the US economy sets the tone for the rest of the world. And most of the other central banks globally will follow. So calendar year 2024 should be a period when we should see a lot of rate cuts. The only exception will be probably Japan, where they are beginning to normalize policy in the other way. So they are still coming out of their post-COVID situation. But rest of the world, we should see interest rates come down, as it should be in India. So in that sense, going back to our early part of our conversation, we are lengthening portfolio durations. Because when rates go down, you want to have longer duration on your portfolio so that you expect to make capital gains on top of the yield on the instruments.
Fantastic. Siva, thanks a lot for that conversation. Just to kind of summarize what we spoke about, fixed income instruments have coupon and there is price risk. the price is driven by the interest rate in the environment, because if the interest rates go up, then the price will fall so that the yields become equal, and vice versa. Bonds are typically negatively correlated with equities, because when economies are doing well, there is more kind of money chasing lesser goods, and hence kind of interest rates go up, or alternatively inflation is going up and hence people need to kind of raise interest rates, and vice versa. So, and when economies are doing well, then the stock markets are doing well. So bonds don't do that well, or stock does well. This hasn't worked out so well in the last 10 years or so, because of central bank action, which has caused both asset classes to move in the same direction. But over a period of time, we should see that kind of come back. The price risk is notional if the bond is held to maturity, but it may not be notional because there may be a need to kind of liquidate in between, as we've seen with some of the instances that have happened. And negative interest rates have caused some dislocations, major dislocations, which are now playing out in a few areas. Interest rates, we've gone through a very steep upward cycle, but looks like we are towards the end of that, and we should see some easing going forward. A great conversation, Siva. Thanks a lot for your time, and we hope you enjoyed this conversation.
Thank you, Samir, and I hope this is useful for everybody. Thank you very much.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.